Hey everyone, thank you for joining us for this edition of Thought and Action. Today I will be speaking with Jonathan Gopman. He's a partner in the area of tax, trusts, and estates with Akerman. He's very, very well versed in this area. It's going to be a great episode. The thought for the day is, what are you going to do when taxes go up? We don't have any confirmation exactly on how it's going to look yet, but the Biden administration is likely going to raise taxes. So the thought is, what are you going to do? The action is take some of this information, dig into it a little more, and get your team together to come up with a plan that can help you kind of navigate whatever these changes may be and come up with a favorable tax situation yourself. All right, welcome everyone to Thought and Action. Got an awesome guest today, Jonathan Gopman, partner in the area of tax, trusts, and estates at Akerman. Want to dive into it because he's talking about a topic that I think is near and dear to a lot of people right now, which is what you need to do from a tax perspective surrounding the upcoming potential Biden tax increases. So with that said, I want to just kind of turn it over to Jonathan and let him talk through just kind of some of the categories that of people I think this really is going to resonate with. So if you're in this category or in these categories, you would definitely want to listen in. So you want to just kind of give that cursory overview, Jonathan?
Yeah, sure. This is really about tax mitigation. So let's take a couple of different scenarios. You're selling your business this year. You got a major equity infusion, so you're taking some of the risk off the table by selling all or part of your business. So you're facing a large capital gains tax. You're looking at the Biden Green Book, and you see the potential for it to be retroactive to the time it was announced much earlier this year. So if you close your transaction now before the end of the year, you're still going to get hit with the higher rates, assuming there is tax legislation that passes. So capital gains right now are taxed at 20% rate, and if that changes, anything over $1 million in gain crunched into 1 year would be subject to tax at ordinary rates, plus the Obamacare tax, the net investment income tax, tax on net investment income of 3.8% added to that. So it's a pretty hefty tax bite, and it can drastically change the mergers and acquisitions market. And a lot of that is going to have to be rethought on how you structure deals. And even in the lower rates, we still have people come to us because the tax bills can be quite large. And then the second, situation that I'd like to cover is when you have an active business, you don't want to sell it. The business is doing extraordinarily well. It delivers a substantial amount of profits because it's run well. It'll continue to be run well. But again, you're still subject to very high tax rates, both probably at the state and federal level. And what can you do to mitigate the tax burden there, if anything at all, is possible? So we'll focus on that. So you're selling your business. There at any one time, there were typically, between 5 to 10 exceptional strategies that we work with. Now, again, we always ask a client about risk level tolerance. Some people say they have little risk tolerance. Some people say their tolerance for risk is much higher. So we like to understand that, because there are certain transactions that we work with where, I would tell a client that there is little to no risk, because it's black and white the way the transaction works, and you still get a very good tax result. And then we have other types of transactions where the risk is higher. It doesn't mean that the transaction doesn't work. It just means that the service is likely to disagree with an interpretation of a provision of the Internal Revenue Code that gets you to that tax result. So in that situation, we'll always recommend that a client gets what's called at least a more likely than not tax opinion from a qualified law firm, such as my law firm or another law firm in the area. Typically, if we're doing the transaction, we'd like to get an independent law firm to opine on the transaction, so you don't have the law firm that's assisting the client in implementing a transaction writing that same opinion letter. You have those two types of situations, and again, typically we'll work with between 5 to 10 planning strategies at any one time. That fall within those categories. One where they're very low risk, and others where they're high risk. So and on the low hanging side of the tree, if you're earning a large amount of income for your business, or you're selling your business, consider making charitable gifts in that year. Again, very unsexy, or it lacks sex appeal, so to say. But again, the any type of charitable planning, if it's done the right way, can be on a very low risk level, and you get the most bang for your buck when you're in high income or years where you have income bunched together. So we always like to look at that. There's a whole bunch of different strategies. Whether you set up your own private foundation, which is a private family charity, which is governed by certain rules, so you can't really abuse you can't abuse the situation, otherwise you'll get into significant trouble. You have gifts to donor advised funds, direct gifts to public charity. Then you have these whole set of animals that we refer to as split interest trusts, where you get a deduction for a gift going into the trust. You retain an income stream for 20 years or up to 20 years, or your life or your joint lives if you're married. And then after the term is done, whether you die or the survivor of a husband and wife pass away, or the 20-year term is done, then what's ever left in that trust goes to charity. And again, those are simple types of strategies. Then we have more complex strategies, like one that's becoming very popular right now. That again is more on the side that I would refer to as very low risk, is what we call solar tax credit deals and other tax credit deals as well. So the solar tax credit deals are very popular right now. Basically, you take the dollars that you otherwise would have paid Uncle Sam in tax, and you invest them into a solar tax credit deal. Now, the way this basically works, and there's a lot of very good deals out there. You have to deal with the more reputable and prominent developers in the business, but there's a lot of them out there. The high quality ones are usually available in June or July. So if you're interested in doing this, this is the time to be doing it. Otherwise you're going to be looking to deals to offset income for next year. But you invest dollars in the deal, you get a tax credit between 24 to 30% of your investment. There's some right now the tax law provides a 24% tax credit, but there are some grandfathered deals that these developers or promoters still have that you can get into, and you can use that to offset your current year tax liability, whether it be operating income or whether it be capital gains. And you can also take some of that credit or all of it, and you can apply it towards last year's tax income and get get a tax refund. Then you also get bonus depreciation on the remainder of the investment too. So you get the write-off in year one. Now again, certain states have different rules here, so that's at the federal level. So you need to check to see if your state coordinates with the federal tax system, or whether you have to take the bonus depreciation a little differently. But again, the numbers usually work out great. So instead of paying Uncle Sam the money, you invest in the solar tax credit deal. You now have an asset. You've saved your tax liability, and this is on very simple terms, okay? And then you also get a return on that. Most of these solar deals on a per $1 million basis return about 4%. So let's say you put $8 million in, and you get a check for $320,000 a year on that. Many of these promoters allow you, or in the deals you go into, allow you to borrow between 50 to 65% of your capital at very favorable rates too, which makes this a very attractive transaction as well. And when you run the numbers, it can show you that you come out far, far ahead when you do a solar tax credit deal. And again, you can use these to offset business income, going into these deals. So people are using them for that situation, and you can use them to offset capital gains on the sale of a company, regardless of the tax rate.
Right. So you're talking right now, Jonathan, about what I like is you some of these things are transactional. They're in a moment. We're going to pull a lever. It's 2020. It's 2021, and I'm going to make a decision that's going to impact me in this bubble. But then there's some things you talked about as well that are structural, that seem like they can have kind of an ongoing, you can enter into that structure, and it can have an ongoing impact, not just into 2020 and 2021, but you can use this kind of going forward. So you can really kind of match up some of these things and create a lasting, strategy that you can also then use tactical things every year to complement. Is that fair?
Yeah, well, mixing and matching is important to get you the right strategy that'll work for a particular client, because not every strategy is a good fit, for one particular client versus others. Right. So you do customize. So you have to understand how these work, how that restricts the capital or doesn't restrict the capital. You have to understand the cost of getting involved. But in all these situations, the cost of getting involved is minuscule in comparison to the tax savings. And that's what's important for the client to focus on. But yes, most of these transactions that we do have long-lasting effects, and they put you in a very, very favorable tax environment. So, for instance, one of the things that you and I have been discussing over the last few weeks is the private placement life insurance policy. And,
Right.
as traditional insurance, you get tax-free buildup, and you can pull out tax-free, the gains inside a policy if you either draw down on your basis or you take a loan against the policy. So you could have millions upon maybe hundreds of millions of dollars of cash value inside of a policy that's designed the right way and it's administered as a life policy. And you can actually have closely held businesses that are operated inside those policies if you have the right type. Again, you got to have the right type of situation and the right type of company, but that's a possibility. And you can also sell assets from inside of a, closely held assets from inside of a policy and eliminate the gain on that sale. So, there are creative use there of these types of structures, but in most of these situations that we're creating a beneficial tax environment that'll either have a serious impact on the initial transaction you're doing, or in many cases as well, a long-lasting impact year after year of putting your clients in a very favorable tax environment.
Right. I like that phrase, a favorable tax environment, because it does seem like that's what everyone's trying to shift towards. Do you see right now most people looking to kind of do, kind of those one-off transactions, or do you see people kind of trying to say, all right, I know these changes are going to be lasting. I need to shift my tax environment to something that's more beneficial as well, and people kind of sitting down to take a look at everything and really kind of say, what are my options? Whether it's selling a business, mitigating my income, how do I shift it? And I guess if I could follow that up, how long does it take to really analyze a situation and come up with a proper strategy?
You can come up with a strategy within a few hours if you really thoroughly understand what the client's objectives are, what they do, the type of income they earn. And again, what I caution people is not every planning strategy is right for you. You have to understand not only the initial tax consequences, but the tax consequences on a go forward basis. That being said, I like to look for strategies that are just extremely flexible, provide you with the ability to use your capital in any way you want, provide you with very favorable tax benefits. And that doesn't mean we might have to be creative in administering the structures, but if a client comes in 5 years and says, I need to do this or I need to accomplish that, let's work with the client and find a way to accomplish that client's objectives. Not lock them up, in a strategy that is going to restrict them so significantly that they're not going to be able to operate their business, or they're going to miss out on some significant investments in the years to come. So that's we want to be very careful there. But literally, at any one time, we're working with those, again, between 5 to 10 strategies that are highly creative, that are most of which are low type of risk transactions. That doesn't mean there's no risk, but low risk actions, and should always get you a very favorable tax result. And again, it's just a question of figuring out, what the risk tolerance level is for that particular client.
Right. So I know that when somebody hears this, they may think to themselves like, what is the risk? Like if I do some of these strategies that are a little bit more quote unquote risky, obviously they're probably going to have a slightly larger reward. That's why you'd consider it. But what kind of risk? You took an audit risk, or what's the risk to somebody that may engage in something like that?
It's an audit risk. You're concerned about something being picked up on audit and then incurring the cost of an audit, and then incurring the potential cost of a tax court trial. So, and that's why it's important to understand that risk and how it works, and what your financial outlay may be if you have to deal with an audit, and if you don't get through the audit favorably, how you deal with that going on to tax court, either arguing with the service in tax court or paying the tax and then filing for a tax refund in a federal court case outside of tax court. And that can get rather expensive. Now, if the service is deemed to take a specious position, they may end up paying your attorney's fees, but more often than not, that's not going to be the case. So you really have to understand that risk. And in a higher risk transaction, that's why you always want to use an opinion letter, because that wipes out the potential for penalties. when you have a qualified opinion letter. And, and then, you understanding, the process of how to settle that type of case. If you don't want to take it, you're risk averse and you don't want to go to court and actually end up with a with a final judgment, which could take a number of years, and the uncertainty, and the anxiety that produces when you're dealing with a tax issue with the Internal Revenue Service. So I think it's very important from a psychological standpoint to understand that. But again, that being said, there are a number of these transactions that are not, that really don't carry risk. Tax credit deals, for instance, that we tend to see, particularly in the green energy area right now, and certain land credit deals, carry no risk, because that's black and white. It's really a question of finding the volume of those deals, the inventory of those deals, which is the difficult thing to do, and that's where we come in. We have that inventory available to us, and so we can help you take advantage of those tax credits, and then we can structure how you hold hold those investments, because that tax credit, that investment that produces the tax credits, an actual asset.
Yeah. I like it. I mean, I wanted you to go through the risk just because I know people would think like, well, what risk is he talking about? But I also like the fact that you brought up not everything has those risks. There's a lot of things that are very black and white that have a massive impact. And I think a lot of it's just knowledge. And you named a bunch right from the get-go. Just as we kind of wrap this up.
You picked it up. Yeah, you picked it up, or just to say one more thing, it's a question of, you're working in this space and you kind of get for what's going on and, and what's happening at the Internal Revenue Service, and in the tax courts. And so, for instance, I'll just give you an example. We were using captives for a number of years. This goes back 10 or 15 years with me, and very successfully. And we still have a lot of good captives, most of which have not been audited. But there's a tremendous amount of cases out there right now involving captives. There's more audit risk because there's more reporting requirements that come in. And this is an industry that's been around for more than 100 years, and it's a very acceptable industry. But like anything else, because so many people are getting involved in invited abuses, so we found alternatives that don't require the reporting. You can get the same type of insurance coverage that you get through captives, and you get the same beneficial tax, or actually you can get better beneficial tax results. Or tax benefits from certain transactions that, tend to mirror what a captive may look like, but again, produce a significantly better tax result. So, when you got your pulse on what's happening out there, and you see where the world is morphing, you can find a better map to work with, and and help steer clients towards that better mousetrap where the risk of audit is substantially lower, if not non-existent.
I like that because it's like you're really nimble in what you do, and it's very similar. Like, I mean, investments are just a tool, and the legal strategies and tax strategies that you help implement are just tools to help people, create, maintain, and keep their wealth that they're building. So, outside of everything else we've talked about, are there any other things that you wanted to kind of highlight before we sign off, whether it be a sale or ongoing income that you think people need to know about?
Yeah, one thing I really like that we spent a lot of time working on is a transaction that involves we call enterprise risk insurance, which again, you've seen in the captive world, but in a very different way. And and again, and what we do is we actually have a licensed insurance company that sells these products, enabling you to take advantage of it. You actually have a better long-term tax result. So the economics here for people getting into this, or businesses getting into it, which again is a type of insurance policy that anyone in a business should have. They should have these types of protections. And then we actually have a way of designing that now where the deduction going in, you get tax-free buildup of your capital inside of the structure, and the release of funds from what we call a risk pool. In the insurance policy, because you have to have a certain amount at risk in a risk pool for at least a year. And then we actually have a way of withdrawing the capital from that structure without ever paying tax, using private placement life insurance and an insurance dedicated fund that we created to plug into that. So it's very creative to deal with active business income and mitigating the annual tax bite.
Well, I tell you what, I mean, I think the one thing that if anybody's listening, I think needs to come away with is you need a team that's actually talking to them to each other. Like you can't do this in a vacuum. You need an attorney, an investment person, whether it's an insurance or wealth advisor or whatever. But everybody needs to be talking because these things are creative, but they need to be massaged a little bit so that it all works fluidly together and works well. So I thank you, Jonathan, for kind of laying those basics out. I know it goes into a lot more detail, and obviously you being part of the team helped put those things together and do a great job with it. So thank you for being on, and thank you for sharing your knowledge.
Yeah, you're welcome. Thank you for inviting me.